Welcome, weary traveler of the waking world. You found your way here, to this quiet corner of the digital night, seeking not just a story, but a balm, a gentle unspooling of the day's tight knots. Perhaps your mind still hums with the echoes of deadlines, the quiet anxieties of tomorrow, or a persistent whisper of responsibilities. It's a common condition, this feeling of always being on, of a mind that refuses to switch off, even when the body yearns for rest. We live in a world that often equates busyness with worth, where the hum of constant activity is mistaken for progress. But what if I told you that true advancement, true peace, can be found in the stillness? What if the most profound work happens not when we are striving, but when we surrender? This is not just another tale to lull you to sleep. It is an invitation to a different kind of awareness, one that embraces the wisdom of repose. In this unique experience, we're going to explore something fundamental, something that touches every aspect of our lives, yet often remains a source of stress and complexity: money. But we won't be talking about stocks and bonds or the anxieties of the daily market report. Instead, we will treat money itself as a character, a silent, persistent presence that has woven itself into the fabric of human history, from the earliest barters in ancient Mesopotamia to the invisible transactions of today's digital age. It's a character that whispers in the ear of empires, shapes the destinies of nations, and, crucially, affects the quality of your own sleep. We will trace its journey, not through the dry lens of economics, but through the captivating lens of narrative, discovering how its rhythms have evolved and how, by understanding these rhythms, we can find a new sense of equilibrium. The common perception is that money is a force external to us, something to be chased, managed, and feared. It's often the antagonist in our waking dramas, the source of worry that keeps us awake at night. But this perspective, I believe, is incomplete. What if we shifted our gaze? What if, instead of seeing money as a problem to be solved, we began to see it as a force to be understood, a flow to be harmonized with? This is the premise of our journey tonight. We will learn to listen to its subtle language, to recognize its patterns, and, in doing so, to release the tension it often engenders. This is about reclaiming a sense of agency, not by wrestling with financial pressures, but by understanding the deeper currents that govern them, currents that have been flowing long before we arrived and will continue long after. The purpose of this narrative is not to impart a complex financial strategy, nor to delve into the intricacies of investment portfolios. The goal is far more elemental: to cultivate a profound sense of trust and ease regarding this ubiquitous element of our lives. We will explore how, throughout history, the very concept of wealth and exchange has shaped human societies, influencing our desires, our fears, and our relationships. By tracing these historical threads, we will begin to see that the anxieties surrounding money are not necessarily inherent to money itself, but rather to our modern, often frantic, relationship with it. This story is about reimagining that relationship, transforming it from one of struggle and apprehension into one of calm understanding and even, dare I say, cooperation. As you settle in, let the day's worries recede. Imagine yourself a traveler, not to a place, but through time and concept. We are embarking on an exploration that will lead us from the dusty bazaars of forgotten empires to the sleek, silent servers of our current digital age. The narrative will unfold gently, like a slow river carrying you downstream. Each tale, each historical vignette, each folkloric whisper will serve to illuminate a facet of this fascinating character we call money. You will be encouraged to reflect, to ask yourselves quiet questions that resonate with your own experiences, to ponder the unseen forces that shape our material world. The ultimate aim is simple yet profound: to allow you to drift into a state of deep relaxation, knowing that by simply listening, you are engaging in a process of profound personal and financial recalibration. This is about finding peace, even in the presence of abundance and the complexities of wealth. Now let your breathing deepen. Let the sound of the world around you fade into a gentle hum. Allow the narrative to wash over you, a soothing tide that carries away the remnants of the day. This is your time, a sacred interlude where learning becomes an act of surrender, and where the secrets of history and human nature unfold in the quiet theater of your mind. Prepare to discover that rest is not idleness, but a vital force, and that understanding the rhythm of wealth can be as simple and as profound as listening to a story. The journey begins now. The very first glimmers of organized human society were inextricably linked to the concept of value. Think back, if you can, to the ancient city of Babylon, a marvel of its time, a hub of trade and innovation. It was here, or in similar early settlements, that the rudimentary seeds of what we now call finance were sown, not in gleaming towers of glass and steel, but in the earthy practicality of exchange. Imagine the scene: merchants with their wares, farmers bringing in their harvest, artisans displaying their crafts. How did they ensure fair trade? How did they store their surplus, their accumulated worth? It wasn't just about the physical goods. It was about the abstract notion of a universally accepted medium, a way to represent value that could be held, transferred, and, crucially, trusted. This trust, or the lack of it, has been the bedrock of every financial system ever devised. Consider the humble beginnings. Before coins, before paper money, there were commodities: grain, cattle, shells, salt. These had intrinsic value, but their transportability and divisibility were problematic. A herd of cattle is difficult to break down into smaller transactions. A sack of grain can spoil. This inherent inconvenience spurred innovation. The invention of coinage, with its standardized weight and markings, was a monumental leap. It allowed for a more fluid exchange, a simplification of transactions that fueled the growth of cities and empires. The image stamped on the coin was a promise, a guarantee from a ruler or a state, a nascent form of centralized trust. Did you ever stop to think about the sheer audacity of that invention? To create something out of metal that held such power, such social weight? As societies grew more complex, so did their financial instruments. The desire to move wealth across distances, to protect it from theft, and to facilitate larger-scale ventures led to the development of early forms of banking. In ancient Greece and Rome, temples often served as secure depositories for wealth. Money changers, evolving from their earlier roles, began to offer services like lending and safekeeping. These were not the impersonal institutions we know today. They were often family-run businesses, where reputation and personal relationships were paramount. The whispered word, the handshake deal, these were the foundations of early finance. And in these early systems, the concept of interest, though often viewed with suspicion by some moral and religious doctrines, began to emerge as the price of using another's capital over time. It was a silent recognition that time itself, or the deferral of immediate use, held value. Centuries passed, and the world continued to spin, carrying the evolution of money along with it. The Silk Road, a legendary network of trade routes, was more than just a conduit for goods. It was a conduit for ideas and for financial practices. Merchants traversing vast distances needed ways to transfer funds without carrying chests of gold, which were a constant temptation to bandits. Bills of exchange, precursors to modern checks, began to appear, allowing debts to be settled across cities and even continents. This innovation represented a significant abstraction of wealth. Money was becoming less about the physical object and more about the promise, the entry in a ledger, the agreement between parties. This growing reliance on trust and information, rather than just tangible assets, marked a profound shift in human civilization. Think about the Renaissance in Europe. This was a period of immense cultural and economic flourishing, driven in no small part by advancements in financial practices. The Medici family in Florence, for example, built an empire not just on banking, but on sophisticated financial management, investment, and the shrewd understanding of credit and debt. They pioneered double-entry bookkeeping, a system that brought unprecedented clarity and control to financial dealings. This allowed them to track their assets and liabilities with remarkable precision, enabling them to make informed decisions and manage risk effectively. It was a testament to how organized knowledge, applied to the abstract world of finance, could yield tangible, monumental results. But with the growth of complexity came new forms of anxiety. As money became more abstract, more reliant on systems and institutions, it also became more mysterious, more prone to speculative bubbles and crashes. The tulip mania in the Netherlands in the 17th century is a classic example of how human psychology, amplified by financial instruments, could lead to irrational exuberance and subsequent collapse. People were investing fortunes in tulip bulbs, not for their beauty or their horticultural value, but for the sheer expectation that their price would continue to rise indefinitely. When the bubble burst, fortunes were wiped out overnight. This tale serves as a timeless reminder that the perceived value of money and the assets it represents is deeply intertwined with human perception and collective belief. It raises a question for us to ponder. How much of our own financial security is built on a foundation of shared belief? And how susceptible are we to the collective moods of the market? Moving into the industrial age, money became even more central to the functioning of society. The rise of corporations, the need for massive capital investment in factories and infrastructure, led to the development of stock markets and more sophisticated financial institutions. Paper money, backed by gold or government decree, became the norm in many parts of the world. The Industrial Revolution was, in many ways, a revolution of finance, enabling the mobilization of vast resources to fuel unprecedented technological advancement. Yet, this era also saw the widening of economic disparities and the recurrent cycles of boom and bust that characterized the era. The power of money was becoming both more democratized through broader access to investment and more concentrated in the hands of those who controlled the major financial levers. The 20th century brought further transformations, most notably the decoupling of currency from gold and the rise of fiat money. Currency declared by a government to be legal tender, but not backed by a physical commodity. This was a bold experiment, placing immense trust in stability and good governance of nations to maintain the value of their currencies. It allowed governments greater flexibility in managing their economies, but also introduced new risks and debates about inflation and monetary policy. The global financial system became an intricate, interconnected web, where events in one corner of the world could have ripple effects felt almost instantaneously everywhere else. And then came the digital revolution. The advent of computers and the internet has fundamentally reshaped how we interact with money. Transactions that once took days or weeks, involving physical movement of cash or checks, can now happen in milliseconds with a tap of a screen or a click of a mouse. This has brought unparalleled convenience and speed, but has also introduced new layers of complexity and, for some, a sense of detachment from the tangible reality of wealth. When money exists only as digits on a screen, it can feel less real and perhaps paradoxically more elusive and harder to control. We've moved from tangible coins to paper promises and now to invisible streams of data. Where does value truly reside in this ever-evolving landscape? Consider the concept of digital currencies, like Bitcoin. They represent a radical departure, seeking to bypass traditional financial institutions altogether, operating on decentralized networks. This is a fascinating and sometimes unsettling development that challenges long-held notions of trust and authority in finance. It's a reflection of our ongoing quest to find the most efficient, secure, and perhaps even the most equitable ways to manage value. What does this ongoing evolution tell us about our deepest human desires concerning security, freedom, and control over our own resources? It's a question worth pondering as you relax and let these ideas settle. Now, let's bring this back to a more personal level, to your own experience. The stories of Babylon, of the Renaissance bankers, of the speculative frenzy of tulip bulbs, of the digital ether, they all share a common thread: the human element. Fear, greed, trust, foresight, ignorance. These emotions and characteristics have always been the driving force behind financial markets and individual financial decisions. The systems may change, the instruments may become more sophisticated, but the fundamental human drivers remain remarkably consistent. And it is precisely this consistency, this enduring human element, that often fuels the anxiety that keeps us awake at night. We worry about our place in this grand, often chaotic system. But what if we could find a way to navigate this system with a greater sense of calm and confidence? What if, instead of viewing money as an adversarial force to be constantly wrestled with, we began to see it as a partner, a tool, a flowing energy that can be understood and guided? This is where the idea of money as a character in a bedtime story truly takes root. In the quiet of the night, when the demands of the day have ceased, we have an opportunity to shift our perspective. We can begin to listen to the subtle rhythms of wealth, not with the urgency of immediate need, but with the detached curiosity of a wise observer. Think about the concept of compound interest. It's often hailed as the eighth wonder of the world, a testament to the power of time and patience. A small sum reinvested and allowed to grow can, over decades, become substantial. This is money working for you, even when you are not actively managing it. It's money that, in a sense, sleeps and dreams of growth and awakens multiplied. This is the essence of what we're exploring tonight. The idea that rest and a lack of frantic activity can be a powerful engine of prosperity. It's a counterintuitive notion in a world that glorifies constant hustle, but it's a deeply ancient wisdom. The earth rests in winter to bloom in spring. Seeds lie dormant, gathering potential. True growth often requires periods of stillness and quiet accumulation. As we continue our journey, we'll explore the folklore and philosophies that have grappled with wealth and contentment. Many traditions, from Eastern philosophies emphasizing detachment to certain Western mystics who viewed material wealth with suspicion, offer profound insights into how to live a fulfilling life, regardless of one's financial status. These aren't about rejecting money, but about understanding its role, its limitations, and its proper place within the larger tapestry of meaningful existence. It's about recognizing that true richness extends far beyond the digits in a bank account. It encompasses health, relationships, purpose, and peace of mind. This story, then, is an exercise in reframing. It's about taking the often intimidating subject of finance and transforming it into something more accessible, more poetic, more sleep-inducing. By tracing the historical narrative of money, by understanding its evolution, we can begin to demystify it. We can see that the anxieties we feel are often echoes of timeless human struggles, amplified by modern pressures. But by cultivating a calm, curious, and informed perspective, we can begin to loosen the grip of those anxieties. We can learn to trust that, just as nature has its cycles, and just as the body heals and rejuvenates during sleep, so too can our financial lives find a state of balanced, sustainable growth. So, I invite you to lean back, to let the narrative wash over you. Allow the history, the folklore, the quiet wisdom to seep into your consciousness. This is a Historia di Dormir, designed not to eliminate money from your life, but to integrate it more peacefully into your existence. It's about developing a relationship with wealth that is built on understanding and trust rather than fear and compulsion. Because when you understand the rhythm of money, when you see it not as a relentless taskmaster, but as a flowing current, you can begin to relax. You can trust that even as you sleep, the world of value continues its intricate dance, and that your own place within it can be one profound peace and growing abundance. What if the secret to financial well-being isn't about frantic activity, but about strategic stillness? As you drift deeper into slumber, consider the ancient adage that time is money, but perhaps it's also true that money is time. Time to rest, time to think, time to be with loved ones, time to simply be. This Historia di Dormir is about reclaiming that time by understanding the very essence of what allows us to have it, a healthy, balanced relationship with wealth. And as you listen and as you sleep, you may find that this understanding begins to transform not just your finances, but your entire sense of well-being, a quiet multiplication of peace within you. Now, let us continue this gentle descent. Imagine the dawn of a new financial era, one where our relationship with money is not one of constant vigilance, but of quiet confidence. We will weave together the threads of history, legend, and philosophy to create a tapestry of understanding that will help you drift into a restorative sleep, knowing that you are embracing a wisdom as old as civilization itself. This is more than a story. It is a pathway to tranquility, the very concept of store value, a way to transcend the immediacy of the present and secure the future, has preoccupied human minds since the earliest days of settled communities. Think of the ancient Egyptians, meticulously constructing vast pyramids and granaries. These weren't merely monuments to pharaohs or places to store grain. They represented an immense accumulation and preservation of wealth, a testament to a society's ability to organize resources and project power across generations. The labor, the materials, the sheer logistical undertaking. It all speaks to a deep-seated human drive to create something enduring, something that represents a surplus of effort and value, a bulwark against the uncertainties of time and nature. Then, let's cast our gaze toward the vibrant, bustling markets of medieval Europe. Here, the merchant class began to rise, not just as traders, but as innovators. They developed sophisticated systems of credit and debt, allowing trade to flourish across greater distances and on larger scales than ever before. Guilds emerged, setting standard for equality in trade practices, creating a framework of trust and mutual benefit. While often romanticized, these were practical, often hard-nosed individuals who understood the power of deferred payment and the leverage that well-managed debt could provide. They recognized that money wasn't just a medium of exchange, but a tool for growth, a lubricant for the wheels of commerce. It was in these bustling centers that the earliest forms of banking, as we might recognize them, began to take shape, often operating out of churches or the homes of wealthy merchants. Consider the whispers of folklore and the allegorical tales that have sprung up around wealth throughout history. Many cultures have stories of hidden treasures, of cursed gold, of spirits that guard riches. These narratives, while seemingly fantastical, often served a deeper purpose. They reflected humanity's complex relationship with abundance, the awe it inspired, the desire it ignited, but also the fear of its corrupting influence and the potential for misfortune to accompany great wealth. These tales acted as a form of collective wisdom, cautioning against greed and promoting virtues like generosity and stewardship. They imbued the abstract concept of money with a moral and spiritual dimension, recognizing that its pursuit and possession carry profound ethical implications. How often do we, in our modern, ostensibly secular world, still find echoes of these ancient anxieties and aspirations playing out in our own lives and in the narratives we tell ourselves about success and failure? As we move into the age of exploration and colonialism, money and its pursuit became a driving force behind global expansion. The quest for precious metals, gold and silver, fueled voyages across oceans, leading to the rise and fall of empires. The concept of mercantilism, where nations sought to accumulate wealth by exporting more than they imported, dominated economic thought for centuries. This era saw the birth of powerful trading companies, like the East India Company, which wielded immense economic and political influence, blurring the lines between private enterprise and state power. It was a time when money, in the form of specie and later, paper currency backed by such specie, was literally shaping the geopolitical landscape of the world. The Enlightenment and the subsequent Industrial Revolution brought about seismic shifts in economic theory and practice. Thinkers like Adam Smith began to articulate ideas about free markets and an invisible hand, suggesting that individual self-interest operating within a competitive framework could lead to collective prosperity. This philosophical shift coincided with technological advancements that allowed for mass production and unprecedented economic growth. New financial instruments emerged, such as joint stock companies and bonds, enabling the pooling of capital for large-scale industrial ventures. This was a period of immense creative energy, but also of significant social upheaval and growing inequality, as the benefits of industrialization were not evenly distributed. The 20th century witnessed both the consolidation of the modern financial system and its most dramatic crises. The establishment of central banks, the gold standard, and later its abandonment illustrate the ongoing evolution and debate surrounding how to manage national and international currencies. The Great Depression of the 1930s served as a stark reminder of the fragility of financial systems and the devastating consequences of unchecked speculation and economic downturns. It led to significant reforms, including the creation of deposit insurance and greater government regulation aimed at preventing similar catastrophes. The subsequent post-war period saw a long era of relative stability and growth in many Western economies, often referred to as the golden age of capitalism. However, the late 20th and early 21st centuries have been marked by increasing financial globalization, deregulation, and the rise of complex financial products. The digital revolution has accelerated these trends, making transactions instantaneous and global. The development of sophisticated algorithms, high-frequency trading, and the proliferation of digital payment systems have transformed the landscape once again. We now live in an era where financial markets operate at speeds that are almost incomprehensible to human mind, and where wealth can be created and destroyed in fractions of a second, often without any direct human intervention. This speed and complexity can be both exhilarating and profoundly disquieting. Consider the concept of financial alchemy, the ancient dream of transforming base metals into gold. While the literal pursuit was a dead end, the underlying desire speaks to a fundamental human yearning for creation, for transformation, for bringing forth abundance from seemingly little. In a way, Modern finance, with its leverage, its derivatives, its complex investment strategies, can be seen as a form of sophisticated, abstract alchemy, attempting to multiply value through ingenious mechanisms and the manipulation of expectations. But, like its ancient counterpart, it carries inherent risks and potential for illusory outcomes, if not grounded in sound principles and a clear understanding of underlying value. As you let these historical currents and philosophical reflections gently wash over you, notice how the nature of money has constantly shifted, from tangible objects to abstract representations, from local exchanges to global networks, from slow-moving commodities to instantaneous digital streams. Yet, through all these transformations, the fundamental human drivers, the desire for security, for prosperity, for a better future, have remained constant. And it is these enduring human needs that often fuel our anxieties when we feel out of control of our financial lives. But here's the quiet revelation that this Historia di Dormire aims to nurture. Understanding the historical arc and the inherent human element can be incredibly liberating. It allows us to see that our modern financial pressures are not unique or insurmountable, but part of a long, ongoing human story. It helps to contextualize our own experiences, to recognize that the anxieties we feel have been felt by countless individuals before us in different forms and different eras. This recognition can be profoundly calming, and this is where the idea of rest as productivity truly shines. When we are in a state of constant anxiety about money, our ability to think clearly, to make wise decisions, and act with foresight is severely diminished. Our minds are consumed by worry, by the immediate perceived threat. But when we can cultivate a sense of calm, when we can approach our financial lives with a more detached, informed perspective, perhaps gained through moments of quiet reflection, like this one, we unlock our capacity for genuine problem-solving and strategic thinking. Sleep, in this context, becomes not an escape from financial reality, but a vital part of managing it. During sleep, our brains process information, consolidate memories, and restore cognitive function. A well-rested mind is a more capable mind, better equipped to navigate complex financial decisions. Think of the concept of compound interest, not just in monetary terms, but as a metaphor for the growth of understanding and peace. Small, consistent efforts, in this case, the effort of calmly listening, of reflecting, of releasing anxiety, can, over time, yield significant returns in terms of mental well-being and financial confidence. It's about nurturing a seed of calm, allowing it to grow, rather than frantically trying to force a bloom. This is the essence of approaching money with wisdom and grace. This Historia di Dormire is designed to be a gentle guide, helping you to reframe your relationship with money, transforming it from a source of stress into a more manageable, even harmonious aspect of your life. By understanding its historical journey, its inherent complexities, and its deep connection to human psychology, you can begin to loosen the grip of anxiety. You can start to trust that, by cultivating a calm and informed perspective, you are, in fact, engaging in a profoundly productive act of self-care and financial stewardship. So, as the narrative gently unfolds, allow yourself to absorb these insights. Let the historical parallels and the philosophical musings create a sense of perspective. The goal is not to have all the answers, but to cultivate a deeper sense of peace and trust. Because when you treat money with wisdom and calm, it ceases to be a source of dread. It becomes a tool, a resource, an energy that can indeed rest with you, dream with you, and awaken, multiplied in its potential, just as you awaken, refreshed and ready to embrace the day with renewed clarity and confidence. Now, let the final threads of the story weave their magic. Imagine the profound peace that comes from knowing that, by simply allowing yourself to rest and absorb, you are actively nurturing a healthier relationship with wealth. You are not passively being swept along by financial currents, but consciously choosing to understand and harmonize with them. This is the ultimate dividend, the quiet multiplication of inner peace that this Historia di Dormire seeks to bestow. May your sleep be deep, your dreams be restful, and your awakening be filled with a gentle, multiplied confidence. Let us now delve into the intricate dance between human psychology and the perceived value of wealth. Beyond the historical ebb and flow of empires and currencies, a crucial layer of understanding money lies in its subjective interpretation. Consider the psychological phenomenon of loss aversion, a concept extensively explored by behavioral economists. It posits that the pain of losing something is psychologically about twice as powerful as the pleasure of gaining something equivalent. This means that the anxiety generated by the prospect of financial loss, a market dip, an unexpected expense, often outweighs the elation of a corresponding gain. Consequently, our financial decisions can become heavily skewed by this innate bias, leading us to make choices driven more by the avoidance of pain than the pursuit of pleasure or optimal growth. Now, consider how this applies when you face a seemingly sound investment opportunity versus the stark fear of depleting your savings. The deeply ingrained instinct to protect what you have can often overshadow rational calculation. Building on this, however, we must also acknowledge the role of cognitive biases in shaping our perception of financial reality. Confirmation bias, for instance, leads us to favor information that confirms our existing beliefs. If we believe a particular stock is destined for greatness, we'll actively seek out positive news and dismiss cautionary signals, creating a self-reinforcing loop that can lead to poor decision-making. Furthermore, the availability heuristic causes us to overestimate the likelihood of events that are easily recalled, often due to vivid media portrayals or personal anecdotes. A sensational news report about a market crash might disproportionately influence our long-term investment strategy, even if statistical probabilities suggest otherwise. Consequently, our understanding of financial risk can become distorted not by objective data, but by the ease with which certain scenarios come to mind. Another critical layer is the concept of hedonic adaptation, our tendency to quickly return to a relatively stable level of happiness despite major positive or negative events or life changes. While this adaptation helps us cope with adversity, it also means that the thrill of financial windfall, such as a lottery win or a significant bonus, often fades much faster than anticipated. The initial euphoria gives way to a new normal, and we can find ourselves desiring even greater wealth to recapture that fleeting sense of elation. This suggests that true, sustained contentment might not be directly proportional to an ever-increasing bank balance, but rather to a mindful appreciation of our current circumstances and a focus on non-material sources of fulfillment. Contrasting this with the relentless pursuit of more wealth highlights the potential disconnect between financial accumulation and genuine happiness. Furthermore, the influence of social comparison cannot be overstated. We are inherently social creatures, and our perception of financial well-being is often measured against that of our peers, colleagues, or even idealized figures presented in media. This keeping up with the Joneses mentality can create immense pressure, fostering dissatisfaction, even when our objective financial situation is objectively sound. The constant awareness of others' perceived success can fuel envy and a sense of inadequacy, driving us to spend beyond our means or to engage in riskier behaviors to project an image of prosperity. Consequently, our internal barometer for financial contentment becomes dependent on external benchmarks, which are often misleading or unattainable. This exploration into the psychological dimensions of money underscores a vital point. The systems and historical narratives we've discussed are filtered through our individual minds, shaped by deeply ingrained cognitive patterns and emotional responses. Therefore, achieving a state of financial peace requires not only an understanding of external economic forces, but also an introspective awareness of our own internal landscape. Recognizing our biases, understanding our emotional triggers, and consciously choosing to detach from relentless social comparison are crucial steps in developing a more balanced and serene relationship with wealth. It's about cultivating an internal sense of sufficiency that is less susceptible to the fluctuations of the external world, allowing us to truly rest and let our resources work for us, rather than being worked by them. The very notion of financial planning, when stripped bare of its jargon, is an exercise in foresight, a structured attempt to align future desires with present actions. Yet, this structured approach often overlooks a profound human element, the capacity for intentional detachment. Consider the ancient philosophical practice of ataraxia, a state of serene, untroubled tranquility. In a modern context, this translates to cultivating an inner environment where financial anxieties do not dictate our peace of mind. This isn't about ignoring financial realities, but rather about developing capacity to observe them without allowing them to destabilize our emotional equilibrium. For example, instead of immediately reacting to a market downer with panic-driven sell-offs, one might practice a moment of mindful observation acknowledging the data without succumbing to the emotional urge to act impulsively. Expanding upon this inner discipline, we encounter the concept of financial minimalism. This approach deliberately questions the ingrained societal narrative that equates increased possessions with increased happiness. It advocates for a conscious reduction of material burdens, prioritizing experiences and relationships over the accumulation of goods. By intentionally simplifying one's material life, individuals can free up significant resources, not just financial, but also temporal and mental, that would otherwise be consumed by the acquisition, maintenance, and management of possessions. A family that chooses to forego a large, high-maintenance home for a more modest, functional dwelling, for instance, might find themselves with more disposable income for travel, education, or simply more free time to spend with loved ones, demonstrating that decluttering one's life can tangibly enhance one's sense of abundance. Further still, consider the profound impact of intentional generosity on one's financial psyche. Moving beyond mere philanthropy, acts of deliberate giving can recalibrate our perspective on wealth. When we proactively share our resources, whether financial, material, or skill-based, we shift from a mindset of scarcity and self-preservation to one of abundance and interconnectedness. This act of conscious distribution can foster a deep sense of fulfillment that transcends material accumulation. Imagine an entrepreneur who, rather than solely reinvesting every profit dollar, dedicates a portion to establishing a mentorship program for aspiring business owners in underserved communities. This not only fosters goodwill, but also cultivates a powerful internal sense of purpose and sufficiency, demonstrating that giving can, paradoxically, enhance one's feeling of wealth. Another crucial layer is the application of scenario planning, not merely for financial contingencies, but for life's broader transitions. This involves actively envisioning multiple potential futures, career changes, evolving family needs, unexpected health challenges, and considering the financial implications of each. By playing out these what-if scenarios in a structured, non-anxious way, individuals can develop more robust and adaptable financial strategies. For instance, a young professional might explore not only their current career path, but also the financial realities of pivoting to a different industry or taking an extended sabbatical for personal growth. This proactive exploration can mitigate future financial shocks by fostering preparedness and flexibility, thereby reducing the reactive anxiety that often accompanies unforeseen life events. Moreover, the practice of financial journaling offers a unique pathway to self-awareness. Beyond tracking expenditures, a journal can serve as a space to explore the emotional narratives surrounding money. By documenting not just the transactions, but also the feelings, thoughts, and motivations associated with each financial decision, individuals can begin to identify patterns of behavior that may be detrimental to their well-being. A person might note their tendency to impulse buy during periods of stress, or their reluctance to discuss financial matters with their partner due to deeply ingrained beliefs about independence. This self-reflection, akin to an internal audit of one's financial attitudes, can illuminate blind spots and pave the way for more conscious, deliberate choices, transforming the journal from a mere ledger into a tool for profound personal insight. The concept of financial resilience offers a distinct perspective, moving beyond mere accumulation or avoidance of loss. It centers on capacity to withstand and recover from financial shocks, emphasizing adaptability and strategic preparedness. This involves not just having savings, but cultivating a diversified income stream, understanding insurance as a tool for risk mitigation rather than simply an expense, and building a robust emergency fund that can weather significant unexpected events. For instance, a freelance graphic designer might build financial resilience by not relying solely on client projects, but also developing passive income through online courses or stock photography, and by consistently allocating a percentage of each payment into a dedicated, easily accessible emergency fund, thereby creating multiple buffers against unpredictable income fluctuations. Building on this, however, we must also consider the profound psychological impact of perceived control. When individuals feel they have agency over their financial situation, even in the face of external challenges, their stress levels tend to decrease significantly. This sense of control is often cultivated through education and informed decision-making. For example, understanding the mechanics of compound interest, even at a basic level, can empower an individual to feel more in charge of their long-term financial future rather than feeling subject to the whims of the market. Similarly, actively participating in retirement planning, rather than delegating entirely, can foster a tangible sense of agency. Conversely, the narrative of financial scarcity, often perpetuated unintentionally through media or even well-meaning conversations, can create a self-fulfilling prophecy. When individuals consistently focus on what they lack, their decision-making processes become filtered through a lens of deficit. This can lead to risk-averse behaviors that, ironically, prevent them from seizing opportunities for growth. Consider a young person from a low-income background who is offered a scholarship for a prestigious university, but hesitates due to anxieties about living expenses or future job prospects. Their focus on potential scarcity, rather than the abundance of opportunity presented by the scholarship, might lead them to decline a path that could significantly alter their financial trajectory. Another crucial layer is the integration of financial well-being with overall holistic health. Increasingly, experts recognize that financial stress is a significant contributor to physical and mental health issues. Therefore, strategies that promote financial health often have positive spillover effects into other areas of life. For example, adopting a budget that allocates funds for regular exercise, healthy food, and mental health support can create a virtuous cycle. Improved physical and mental health can, in turn, enhance productivity and decision-making capabilities, indirectly contributing to financial stability. It's a symbiotic relationship where tending to one aspect of well-being positively influences the others. Furthermore, the concept of financial legacy offers a different framing, moving beyond individual accumulation to consider the impact of our financial decisions on future generations. This involves not only the transfer of assets, but also the transmission of financial knowledge, values, and responsible habits. For instance, a parent who consistently involves their children in age-appropriate financial discussions, teaches them the principles of saving, and models responsible spending habits is building a far more valuable legacy than simply leaving a large inheritance without the accompanying wisdom. This forward-looking perspective can imbue current financial decisions with a deeper sense of purpose and long-term significance. The burgeoning field of behavioral economics offers a fascinating lens through which to examine our often irrational interactions with money. It moves beyond a classical economic assumption of a perfectly rational actor, acknowledging that our financial decisions are profoundly influenced by psychological factors, cognitive biases, and emotional heuristics. One key concept here is present bias, which describes our tendency to heavily discount future rewards in favor of immediate gratification. This helps explain why saving for retirement, a distant goal, often loses out to the allure of a new gadget or an impulsive vacation. Now, consider how this plays out when you're faced with a choice between allocating a bonus to a long-term investment account or using it for an immediate, satisfying purchase. The strong pull of the present moment often overrides logical long-term planning, even when the future benefits are clearly articulated. Building upon this understanding of temporal discounting, we see the practical application in nudging strategies. These are subtle environmental or choice architecture modifications designed to steer people towards beneficial decisions without restricting their freedom of choice. For instance, automatically enrolling employees in a retirement savings plan with the option to opt out has proven far more effective in increasing participation than requiring manual enrollment. This leverages present bias by making the default action the one that benefits the future self, reducing the cognitive effort required to initiate the saving process. Consequently, such interventions can significantly boost long-term financial security by overcoming our inherent inertia. Furthermore, the concept of mental accounting reveals how we compartmentalize our finances, treating different sums of money in distinct ways, irrespective of their fungibility. We might be more inclined to spend found money, like a tax refund or an unexpected gift, more freely than money earned through diligent work, even though the actual purchasing power is identical. This psychological framing means a $500 windfall might be treated as discretionary entertainment funds, while $500 meticulously saved from a paycheck feels like it should be strictly allocated to essential needs or a predefined savings goal. This cognitive division impacts our spending patterns and resource allocation, often in ways that are not entirely rational from a purely economic standpoint. Conversely, the emergence of financial gamification attempts to harness these psychological principles for positive outcomes. By incorporating game-like elements, such as points, progress bars, leaderboards, and rewards, into financial management tools, developers aim to increase user engagement and encourage consistent, beneficial behaviors. Imagine a budgeting app that awards badges for staying within spending limits for a consecutive month, or a savings platform that offers virtual rewards for reaching milestone savings goals. This approach taps into our innate desire for achievement and competition, making the often mundane task of managing finances more engaging and motivating. Another crucial layer is the exploration of anchoring bias in financial negotiations and decision-making. This cognitive bias occurs when individuals rely too heavily on the first piece of information offered to anchor when making decisions. In salary negotiations, for example, the initial salary proposed by an employer can significantly influence the final agreed-upon figure, even if subsequent information might suggest a different valuation. Similarly, the initial price listed for a house often sets the benchmark for subsequent offers and counteroffers. Recognizing this bias allows individuals to approach negotiations more strategically, either by setting their own favorable anchor or by being aware of and discounting anchors presented by others. This awareness empowers individuals to move beyond initial impressions and make more objective assessments of value. Beyond the immediate psychological influences, consider the burgeoning impact of decentralized finance, or DeFi. This revolutionary movement aims to rebuild traditional financial systems using blockchain technology, promising greater transparency, accessibility, and user control, largely bypassing intermediaries like banks. Think of smart contracts, self-executing contracts with the terms of the agreement directly written into code, which can automate complex transactions, lending, and borrowing processes with unprecedented efficiency and reduce counterparty risk. Now, consider how this shift fundamentally alters the locus of trust. Instead of relying on institutions, users increasingly place their faith in the integrity of code and distributed networks, representing a paradigm shift in how financial relationships are structured. Building on this technological innovation, however, lies the growing importance of digital identity verification and its interplay with financial access. As more transactions migrate online and into decentralized systems, robust methods for establishing and managing digital identities become paramount. This goes beyond mere usernames and passwords. It involves sophisticated cryptographic solutions that allow individuals to prove their identity securely and selectively without necessarily revealing excessive personal data. For instance, a user might employ a decentralized identity solution to prove they are over 18 for a financial transaction without disclosing their exact birth date, thereby enhancing privacy while still meeting regulatory requirements. Consequently, the future of financial inclusion is intricately linked to the development of secure and user-friendly digital identity frameworks. Conversely, the rapid evolution of artificial intelligence, AI, and machine learning is profoundly reshaping financial risk assessment and fraud detection. AI algorithms can analyze vast data sets at speeds and with granularity far exceeding human capabilities, identifying subtle patterns and anomalies that might indicate fraudulent activity or predict potential credit defaults. Consider how AI-powered systems can monitor millions of transactions in real time, flagging suspicious activities that deviate from established user behavior patterns or known fraud typologies, thereby offering a proactive defense against financial crime. This technological leap represents a significant enhancement in the security and integrity of the financial ecosystem. Furthermore, the ethical considerations surrounding algorithmic bias in financial decision-making present a critical area of ongoing development. While AI offers immense potential for efficiency, algorithms trained on historical data can inadvertently perpetuate existing societal biases, leading to discriminatory outcomes in areas like loan applications or insurance pricing. For example, if historical lending data reflects systemic biases against certain demographic groups, an AI model trained on that data might continue to unfairly disadvantage those same groups, even if no explicit discriminatory intent is present. Addressing this requires a concerted effort to develop fairer algorithms, ensure data representativeness, and implement robust oversight mechanisms. Another crucial layer involves the concept of financial inclusion 2.0, which leverages mobile technology and simplified digital platforms to reach previously unbanked or underbanked populations. This extends beyond mere access to basic banking services. It encompasses offering microinsurance, digital payment solutions tailored for low-income users, and accessible credit facilities built on alternative data sources, such as mobile phone usage patterns. Think of a farmer in a remote village who can now access crop insurance via a simple mobile app, receiving payouts directly to their phone after a verifiable weather event, thus bypassing traditional banking infrastructure entirely and significantly improving their resilience against agricultural uncertainties. This democratizes financial tools, empowering individuals who were previously excluded from a formal financial system. Beyond the immediate psychological influences, consider the burgeoning impact of decentralized finance, or DeFi. This revolutionary movement aims to rebuild traditional financial systems using blockchain technology, promising greater transparency, accessibility, and user control, largely bypassing intermediaries like banks. Think of smart contracts, self-executing contracts with the terms of the agreement directly written into code, which can automate complex transactions, lending, and borrowing processes with unprecedented efficiency and reduce counterparty risk. Now, consider how this shift fundamentally alters the locus of trust. Instead of relying on institutions, users increasingly place their faith in the integrity of code and distributed networks, representing a paradigm shift in how financial relationships are structured. Building on this technological innovation, however, lies the growing importance of digital identity verification and its interplay with financial access. As more transactions migrate online and into decentralized systems, robust methods for establishing and managing digital identities become paramount. This goes beyond mere usernames and passwords. It involves sophisticated cryptographic solutions that allow individuals to prove their identity securely and selectively without necessarily revealing excessive personal data. For instance, a user might employ a decentralized identity solution to prove they are over 18 for a financial transaction without disclosing their exact birth date, thereby enhancing privacy while still meeting regulatory requirements. Consequently, the future of financial inclusion is intricately linked to the development of secure and user-friendly digital identity frameworks. Conversely, the rapid evolution of artificial intelligence, AI, and machine learning is profoundly reshaping financial risk assessment and fraud detection. AI algorithms can analyze vast datasets at speeds and with a granularity far exceeding human capabilities, identifying subtle patterns and anomalies that might indicate fraudulent activity or predict potential credit defaults. Consider how AI-powered systems can monitor millions of transactions in real time, flagging suspicious activities that deviate from established user behavior patterns or known fraud typologies, thereby offering a proactive defense against financial crime. This technological leap represents a significant enhancement in the security and integrity of the financial ecosystem. Furthermore, the ethical considerations surrounding algorithmic bias in financial decision-making present a critical area of ongoing development. While AI offers immense potential for efficiency, algorithms trained on historical data can inadvertently perpetuate existing societal biases, leading to discriminatory outcomes in areas like loan applications or insurance pricing. For example, if historical lending data reflects systemic biases against certain demographic groups, an AI model trained on that data might continue unfairly disadvantage those same groups, even if no explicit discriminatory intent is present. Addressing this requires a concerted effort to develop fairer algorithms, ensure data representativeness, and implement robust oversight mechanisms. Another crucial layer involved the concept of financial inclusion 2.0, which leverages mobile technology and simplified digital platforms to reach previously unbanked or underbanked populations. This extends beyond mere access to basic banking services. It encompasses offering microinsurance, digital payment solutions tailored for low-income users, and accessible credit facilities built on alternative data sources, such as mobile phone usage patterns. Think of a farmer in a remote village who can now access crop insurance via a simple mobile app, receiving payouts directly to their phone after a verifiable weather event, thus bypassing traditional banking infrastructure entirely and significantly improving their resilience against agricultural uncertainties. This democratizes financial tools, empowering individuals who were previously excluded from the formal financial system. The concept of financial stewardship introduces a distinct ethical dimension, moving beyond mere wealth accumulation to a mindful approach to managing resources for long-term well-being and responsible impact. This perspective frames individuals not just as consumers or investors, but as caretakers of their financial assets, with a duty to ensure these resources serve their intended purpose without causing undue harm. Consider the practice of impact investing, where individuals deliberately direct capital towards companies or organizations that aim to generate positive social or environmental outcomes alongside financial returns. This is not simply about profit. It's about aligning one's financial activities with deeply held values. For instance, an investor might choose to allocate funds to a renewable energy startup or a microfinance institution, believing these ventures contribute more meaningfully to a sustainable future than traditional, purely profit-driven enterprises. Building on this ethical foundation, however, lies the exploration of opportunity cost in a deeper, more nuanced sense. While often discussed in economic terms as the value of the next best alternative foregone, its psychological implications are profound. Every financial decision, from the smallest purchase to the largest investment, represents a choice to allocate finite resources towards one specific outcome, thereby implicitly rejecting countless other possibilities. This awareness can foster a more deliberate and intentional approach to spending and investing. Now, consider how this applies when you're choosing between a lavish vacation and investing in a skill development course. Acknowledging the opportunity cost means recognizing that the vacation, while pleasurable, precludes the potential long-term benefits of enhanced career prospects or new income streams that the course might offer. This framing encourages a conscious weighing of present desires against future potential, fostering a more strategic allocation of resources. Conversely, the burgeoning field of behavioral finance highlights how irrational emotional impulses can significantly derail sound financial planning. Concepts like herding behavior, where individuals follow the actions of a larger group, often leading to speculative bubbles or panics, demonstrate our susceptibility to social contagion even in financial matters. Think of the frenzy surrounding a booming stock market, where individuals invest heavily simply because everyone else appears to be doing so, often disregarding fundamental value. This tendency to conform, even at considerable financial risk, underscores a challenge of maintaining independent, rational decision-making amidst collective sentiment. Another crucial layer involved the concept of financial fluidity as a strategic goal. This refers not just to having readily accessible cash, but to possessing a dynamic and adaptable financial structure that can readily pivot in response to changing circumstances or opportunities. It means having diversified income streams, flexible investment portfolios, and a clear understanding of one's financial obligations and capacities. For example, a small business owner might cultivate fluidity by maintaining both a healthy cash reserve and a pre-approved line of credit, allowing them to seize unexpected opportunity for growth, while also having a safety net for unforeseen operational challenges. This proactive adaptability is key to navigating the inherent uncertainties of the economic landscape. Furthermore, the integration of financial literacy with digital literacy is becoming increasingly critical in the modern economy. As financial services and transactions move increasingly online, understanding how to navigate digital platforms securely, interpret online financial information critically, and protect oneself from cyber threats is as vital as understanding basic accounting principles. Consider the growing prevalence of phishing scams targeting online banking credentials. An individual with strong digital literacy would be more adept at recognizing the signs of such fraudulent attempts and taking appropriate precautions, thus safeguarding their financial assets in the digital realm. This symbiotic relationship between financial and digital acumen is essential for both personal security and economic participation. Reflecting on this journey through the intricate currents of history, human psychology, and technological evolution as they pertain to wealth, we begin to perceive a subtle yet profound convergence. The individual threads, though distinct in their historical or disciplinary origins, now weave together to form a richer tapestry, one that illuminates the complex interplay between our inner landscapes and the external systems that govern value and exchange. It's as if disparate notes, once played in isolation, are now harmonizing to create a more resonant chord, suggesting a deeper, underlying melody that governs our relationship with prosperity. In light of these unfolding insights, the path towards a more serene engagement with financial matters becomes increasingly discernible. The anxieties that once seemed formidable, born from the pressures of an ever-changing economic world, begin to recede as we recognize the enduring patterns of human behavior and the consistent evolution of systems designed to manage value. It's akin to gaining a higher vantage point, from which the vast and sometimes turbulent terrain of finance appears less as an insurmountable obstacle and more as a landscape with discernible pathways and predictable cycles, a terrain that can be navigated with greater wisdom and equanimity. As we pivot toward the final stages of our reflection, consider how the accumulated understanding shifts our perspective from one of reactive struggle to one of proactive harmony. The narrative arc, from ancient bartering to the digital frontiers, ceases to be a chaotic sequence of events and instead reveals itself as a continuous, unfolding story of human ingenuity and adaptation. This comprehensive view offers a unique lens through which to reevaluate our own place within this grand continuum, fostering a sense of connection and continuity that can be deeply grounding, especially as the day's intensity gives way to the quietude of rest. The cumulative effect of these explored ideas is akin to discerning the underlying architecture of a complex edifice. We move beyond merely observing the facade and begin to appreciate the structural integrity, the foundational principles that support its existence. This deeper comprehension allows for more confident interaction with the financial world, fostering a trust not in the inherent stability of markets, which are ever-changing, but in our own capacity to understand, adapt, and derive benefit from their intricate workings, even as we surrender to the restorative embrace of sleep. As we draw the curtain on this exploration, a profound understanding begins to coalesce, not merely as a collection of facts or historical anecdotes, but as an integrated perspective on the very essence of wealth and its place within the human experience. We have journeyed from the earliest cradles of commerce to the cutting edge of digital innovation, witnessing money's evolution from tangible commodity to abstract concept, from local exchange to global network. Yet, through this vast historical panorama, a singular truth emerges, that the enduring power of money has always been intrinsically linked to human trust, perception, and our capacity for collective belief. The systems and technologies change, the instruments become more sophisticated, but the underlying currents of human psychology, our desires, our fears, our aspirations, remain the constant driving force. This realization is not a call to dismiss the complexities, but an invitation to reframe our relationship with them, to understand that true mastery lies not in controlling the external flux, but in cultivating an inner locus of stability and wisdom. The narrative has illuminated how, throughout centuries, humanity has sought to manage, secure, and multiply value, driven by a fundamental need for security and a desire to shape the future. From the disciplined accounts of Babylonian merchants to the intricate algorithms of today's financial markets, the pursuit of prosperity has been a persistent theme. Yet, as we have seen, this pursuit often carries with a shadow of anxiety. The psychological biases we are prone to, the constant social comparisons, and the sheer pace of modern financial evolution can create a sense of being perpetually overwhelmed. This Historia D. Dormier has aimed to gently unravel these pressures, not by offering simplistic solutions, but by fostering a deeper, more nuanced understanding. It's about recognizing that the narrative of financial struggle is often self-perpetuated, and that by shifting our perspective, we can begin to rewrite that narrative, transforming fear into foresight and apprehension into a quiet confidence. Ultimately, the most impactful transformation lies not in the accumulation of more wealth, but in the cultivation of a more peaceful, informed, and resilient relationship with it. The true practice begins now, in the quiet moments, in the conscious decision to approach financial matters not with frantic urgency, but with calm curiosity and profound trust in our capacity for understanding. Rest, as we have subtly woven throughout, is not an abdication of responsibility, but a vital precursor to clarity and effective action. It is in the stillness that we process, integrate, and gain perspective. When money is approached with wisdom, it ceases to be a source of perpetual stress. Instead, it becomes a tool, an enabler, an energy that can align with our deepest values and aspirations. May you find, as you drift into a restful sleep, that this understanding multiplies within you, not just in financial terms, but in a profound sense of inner peace and sustained well-being, a wealth that truly endures.